So mortgage rates hit 6.9%. How much lower can we go? We finally broke below 7% the last few weeks. What's happening? Are we heading down to 6? Are we heading down to 5? Or is this a short lived? Is this going to go all the way up to 7, 8, 9% again? Well, let's find out. So the bottom line is the 10-year treasuries right now approaching the resistance level of 4.32%. And so, what is all this jargon? What is resistance? What is support? So, let me start with the little bond trading basics. So, resistance is the level at which, when interest rates drop, and that's when the sellers flood in. And support is the level at which, when interest rates rise, that's when buyers flood in. So right now we're looking at the 10-year treasuries bound between a 4.32% resistance and a 5% support. So the 10-year treasury is currently sitting at 4.47%. That's what's giving us the interest rates below 7% at 6.9. That's a lot of numbers. So once again, the 10-year treasury is right now at kind of a happy middle spot, just below 4.5%. But the lowest it's expected to go is not too much lower, to 4.32%. So if it falls to 4.32%, that's when the sellers flood the market, and it won't be able to fall much lower than that unless something major happens geopolitically. So what we've seen is a recent improvement in rates because of a softening economic data. What we saw recently is jobs market came in weaker, GDP came in weaker, and declining retail sales. So all of that is leading to the 10-year being pushed down. But will it get pushed down below the resistance level of 4.32%, the level at which sellers will flood the market? I don't think so. The economic data isn't strong, or in this case, weak enough to push rates below that resistance level. So what we see is that, with the news moving the rates up and down, I expect the 10-year treasury to be range bound between 4.3 and 5%. At 5%, interest rates will be well over 7%, closer to 8, 8.5. And at 4.3%, interest rates will be in the mid to low sixes. So that's the range that we're looking at, and don't expect like a major change in interest rates. Don't expect a major boom in the rates market unless there is a new sentiment coming out from the Fed, or unless the economic data dramatically weakens, which is obviously bad for the rest of the country, is arguably good for mortgage originators, but we certainly don't want our fellow Americans to be unemployed. So let's just hope that we continue to move forward, that the country continues to grow, that we post decent GDP numbers, that we get our debt under control, that Americans stay employed, that there's food on the table for everyone, and that inflation comes under control. I would rather see inflation drop due to productivity gains and good economic policy and good fiscal management by the government than to see inflation drop by forcing people to be unemployed. So the current policy of pushing rates up until we break the system is one way to solve the inflation problem, but it is going to lead to a lot of bad misery in the system, and a lot of Americans are going to be hurt. Let's solve the interest rate problem through increased productivity. Let's solve the interest rate problem by reducing cost of fuel, by reducing cost of energy, by reducing the cost to produce everything. And the one way the biggest way to fix those problems, biggest way to hit inflation without hitting the average American, without forcing people out of jobs, is to increase productivity through technology. And yes, we have the tech. This isn't a pipe dream. We have the technology today that will increase productivity and reduce inflation, reduce cost, which will thereby reduce interest rates. That is the right way to do it. We need government policies that promote AI, artificial intelligence. We need good government energy policy that reduces the cost of energy for everyone. And we need greater manufacturing in America of microchips, of 3D printing, of all the basic of robotics, of all the basic fundamental technology that will multiply productivity. And that's the right way to get interest rates down. That's the right way to be looking at the system and running this country. So I'm I can't totally disagree with what the Fed is doing because they kind of have, they don't set those policies. Only policy that they don't set spending policy, they don't set investment policy, they can only set interest rate policy. So given the limited tools they have, this is their only choice. But I'm afraid that by them continuing to raise interest rates the way they are and keeping it here is going to cause a lot of pain and misery for a lot of very good, hardworking Americans. And that's not the best outcome. But for now, for everyone in the mortgage industry, we're looking at 10-year Treasury being range bound between 4.3 and 5%. That means mortgage rates being range bound between 6.5 to 8.5, something in that range. And I don't see a big refi boom coming, at least until the end of this year, until there's something fundamental shift happens in geopolitics or some fundamental shift happens in economic policy set by Congress and by this administration. So cheers. Talk to you again soon.